Hi, and welcome to another webinar from invested.dk. I will do a very short introduction in Danish, and then we will go right to the interview with Gary Brode from Deep Knowledge Investing. Velkommen til. Om et øjeblik stiller jeg om til interview med Gary Brode fra Deep Knowledge Investing, en amerikansk virksomhed, der hjælper fonde og forvaltere verden over med at tage de rigtige beslutninger. Webinaret her er optaget lidt tidligere, da Gary i øjeblikket er i Peru, og vil derfor ikke helt kunne få tidsforskellen til at passe. Der vil derfor ikke være mulighed for spørgsmål, men hæng på, der er tale om et super spændende og aktuelt webinar. So, thank you all for tuning in. Let's go right to the interview with Gary Brode. Of course, we're happy to have you on again. A few months ago, we did a very interesting webinar with you, and this time we're reaching out to you again because we like to have your take on the inflation. As we all know, there's a pretty high inflation at the moment, also here in Denmark. I think it's 4.3 or something like that. So, but maybe first, can you try to tell a little more about yourself and what you're doing for those in our audience who do not know you?
Sure. Thanks, Eric. And thanks for having me back. It was great to speak to your community a couple of months ago from Tamarindo. I'm here in Arequipa, Peru right now, and and thrilled to be back with you in Denmark. And I know I've told you before and told your audience before, when I was very young, I spent a couple of summers in Denmark and stayed with host families and had fantastic experiences and really enjoyed the Danish culture and the Danish people. They were very kind to me. As I've said before, your language is very difficult for me, but I can always say mange tak.
Mange tak, okay, that's enough.
Right, that's what I have. 2 years ago, I started Deep Knowledge Investing. I have a 30-year background in the hedge fund business. And what we do at Deep Knowledge Investing is we help hedge fund managers, portfolio managers, and individuals like people in your community get better equity returns. We do that in 2 different ways. We offer them a limited number of individual stock picks, and we also offer them timely market commentary. And on that, in the 2 years we've been in business, we've made calls to short the market exactly twice. Once was in late February of 2020 before the big COVID shutdowns. The second one was in early January. So anyone who's been with us and has followed either of those recommendations made more money off of that than they're paying us in subscription fees, which is great because that's why we exist. We exist to help people make money. I also want to thank the members of your community. We've had a bunch of them join Deep Knowledge Investing. We're thrilled to have all of you. And like I told you in the pre-interview, we get more good questions from members of invested.dk than from everyone else combined. Your That's people impressive. They're smart investors. They're really well prepared, really well trained. They're engaged. I feel very fortunate to have them as part of our community as well, and I'm so happy to be speaking to all of you today.
That's great. So, where were you in Denmark? Was it in Jutland or when you were a child?
We started in Copenhagen and then traveled throughout the country. We went to, I think, 3 or 4 different cities. So the next time we do this, I'm going to check my old photo albums. And we'll upload some pictures of me as a 13-year-old with Danish host families, and
that would be nice.
I'm sure I can find the classic picture at Legoland, which everyone has.
Okay, that's great. Well, let's discuss the outlook for the economy.
Yeah.
So. We're going to talk about inflation. It's quite high both in the US and in Denmark. But can you maybe tell people what is behind the inflation as you see it at the moment?
Sure. Yeah. So basically, when we first started having problems with COVID, the government understandably was very afraid and decided to shut down the whole economy. And in hindsight, I'm not sure that was the right move, but people were operating with limited information, and we understood it at the time. And there was a certain amount of it that, we supported at the time, although in fairness, we thought that was going to be for 2 weeks, not 2 years. So what the government did was they realized, wait a minute, if we are putting people out of work, we should support them and give them money because they can't work. And there's a certain amount of fairness in that, and we understand that as well. The problem is that they were printing, I don't know, something like $3 trillion, $4 trillion, $6 trillion at a time. And to give you a sense of how crazy all of this is, 80% of all US dollars in existence have been created in the last 2 years, right? So it's been a huge increase in the money supply. And at the same time, a lot of people weren't working. And so the kind of colloquial definition of inflation is too much money chasing too few goods. And that's exactly what we had. And that's where we are right now. Supply chains getting gummed up hasn't helped. The ports are backed up. There are, every time China shuts down a factory because 3 people have COVID, that hurts things as well. But more than anything, it's been a huge increase in the money supply without an increase in the goods available.
Mm. So will this thing finish, do you think, or soon, or will it consist?
Okay, so, and it's really interesting that you asked me that because we have a newspaper article that's in edit right now. Our view is that things are really rough, and I'll take you through why. And I'll take you through why I think the Federal Reserve has no good options. They've painted themselves into a corner. That said, there are people who believe that this is transitory, it's temporary, we'll muddle through as we always do. And we actually have a newspaper article in edit right now where we explain the position of the other side. And these people aren't crazy. I just don't think they're right about this. But they have a legitimate point of view, and it's one that we've considered and have tried to explain to people politely and respectfully, acknowledging the good points on the other side. Here's our position. The official CPI, which stands for Consumer Price Index, which is our measure of inflation, stands at 7.5%. We're on record saying that number is complete and utter nonsense. We actually think inflation is closer to 15%. The current federal funds rate, so the rate at which the Federal Reserve, our central bank, is loaning out money, is right around 0. So officially, the real rate of interest, the real rate of return is negative 7.5%. If you believe our numbers, it's negative 15%. Either one of those numbers would be an all-time record. And on top of that, the Federal Reserve is still engaged in quantitative easing, which is a very fancy way of saying they're printing more money. So in the middle of what we see as a disaster situation, the Federal Reserve is talking about doing something about this, but interest rates are still 0. Real interest rates, depending on whose numbers you believe, are somewhere between -7 and -15%, and they're still printing more money. So I don't think anybody's gotten serious about this. They've gotten serious about talking about getting serious about this, and that's not at all the same thing.
So why do you think the inflation number is nonsense, or why do you think it's higher than the official number?
Okay, so let's go with let's just pick 3 things. The key thing is shelter, which is the fancy word that the US Bureau of Labor Statistics uses for housing. Okay, so back in the late 1970s, early 1980s, we had this horrible malaise called stagflation. And in the United States, we had huge inflation numbers combined with high unemployment. It led to the creation of something called the misery index. And prices were going up and people were going out of work, and the whole situation was really a disaster. So fast forward to 1998, and during the Clinton administration, they decided to revise the calculation for shelter or housing in the CPI. And they went from the actual cost of housing from that, which is what it had always been, to something called owner's equivalent rent, which again is a really fancy way of saying they would go to people who owned homes and ask them, well, if you were to rent your house, what do you think it would be worth? And the truth is people don't know because most people don't rent their homes. And we've put up an article and a graph, but there's a great graph that we have. I can send it to you if you'd like, that shows, sure, I'll send it to you after this and you can share it with your audience. But what it shows is the increase in owner's equivalent rent, which is a very shallow graph, compared to the Case-Shiller housing price index, which is a measure of actual housing prices, and that's much steeper. And so what you see is a huge gap between actual housing prices and the housing prices that are counted for the purposes of the CPI. Now, in the last CPI calculation, Consumer Price Index calculation, it was showing an increase in housing costs of around 4%. That is completely not believable. If you look at Case-Shiller, it's 18 to 20%. If you look at Zillow, it's 17, 18%. If you talk to realtors, and we do, it's 20 to 25%. And the reason this matters is because shelter makes up a full 1/3 of CPI. So if you have a difference between actual housing prices and reported housing prices of 16%, right? And that's 1/3 of CPI, you have to add more than another 5%. That takes your 7.5% number to getting close to 13%. That's just on that alone. The next thing we'd look at is food inflation. And the US government is saying food prices were up 6% 2 months ago, 7% 1 month ago. And we've taken a look. United Nations Worldwide Food Index is up 24%. So, Eric, you know, people in the United States eat a relatively expensive diet. There's lots of meat, chicken, fish, fresh vegetables. The things that Americans eat tend to be pretty expensive. And those are items that have doubled in price. The price of beef is doubled, the price of bacon is up huge, the price of chicken is not up 6%. And so the question you have to ask yourself is, if worldwide food prices are up 24%, is there anyone, and I mean anyone, who believes that food prices in the United States are only up 1/4 of that? If world prices are up 24%, does it make sense that US food prices are up 6%? That's total nonsense. That can't be true. Well, guess what? That's another 10% of the index, right? Right, even if it's only 20% minus 7%, that's 13, that's another 1.3%. Well, guess what? We're closing in on 15 real quickly just on that. The final thing we'd point at is so most people just read the newspaper headlines, and I understand that, right? Of course they do. But at Deep Knowledge Investing, we actually go to the US Bureau of Labor Statistics and pull the report. And we look at the report, and it's our job to do that. And it's our job to do that for you. It's our job to do that for our subscribers. It's not their job to go past the newspaper. But if you pull that report and take a look, they tell you they made 70 adjustments to the CPI. 70. So basically they got numbers they didn't like and said, we're going to change them so we have numbers we like. And Eric, I just have to ask you, do you think the government changed the numbers to make the inflation rate look worse than it is?
No.
No, because high inflation makes the government look bad. So when they do those adjustments, I think anybody with half an ounce of common sense would say they made those adjustments to make themselves look better, and they adjusted the numbers down.
Yeah, but why is it so important if the inflation is high or higher? Can you try to explain that for the audience?
Sure, of course. So let's think about the people in your audience who have jobs and who work, and they work hard, I'm sure. Let me ask you, when they get raises what, once a year maybe? Something like that? Okay. And I'm gonna guess, and you can tell me, but usually when people get a pay raise, unless they got a big promotion, but just sort of a normal pay raise, they get what? 3, 4, or 5%, a nice
Yeah,
little
nice.
addition, right? Am I in the ballpark for what it's like in Denmark?
Yeah, that sounds right.
Okay. So what do you do when a year from now you get a 4% pay increase, but your cost of living goes up 15%
Mm,
during the year? What
mm,
happens? And the reason people are members of your community, the reason people come to Deep Knowledge Investing is because they want to save and invest and do better. But what do they do when their grocery bill is 20% higher? What do they do when
mm,
they can't afford basic things? What do they do when their rent goes up 20%? Right? I mean, these are serious problems. And
mm,
also, I realize as we're talking about this, we're talking about government statistics, and it's interesting to me, but for many people, it's very dry. And we're talking about, well, this government number and this percentage. But what if you're a retiree? What if you're somebody on a
mm,
fixed income,
mm,
right? What happens if you're 70 years old and you're on a pension? Your
mm,
pension doesn't go up if you can't afford your cost of living. Best case scenario is you sell your house and move somewhere smaller, but transaction costs for that could be 10%. It'll cost you a lot of money to make that change, right? And so people have to start adjusting the way they're living down. They have to start living at a much lower level, even though they haven't done anything to create this negative change in their life. The real answer to your question, why do we care? Why does this matter? Why do these statistics matter? Is because behind those statistics are very real people who want to live a decent life, who want to be able to afford a place to live and food and maybe the ability to go out and have a meal at a restaurant every now and then, right? There are real people behind this, and this hurts them. And on top of all of that, and I can't emphasize this enough, inflation is a way of stealing from people who save, and that's your
mm,
community. Your community are people who save money and then fortunately they invest. But what if they're saving in cash? So let's say somebody has, I'm making this up, they've worked very hard and they've saved $10,000. And what if next year it's worth 15% less? So they still
mm,
have their $10,000, but what they can buy with that $10,000 might be worth $8,500, right? And it's basically theft. The value of what they worked so hard for and saved is being eaten away every single year. And
mm.
that's hard for people, and people are being punished for doing the right thing, right? They're being punished for living below their means and saving and investing.
Mm. Do you see any global risk connected to this, to the inflation in each country?
Sure, sure. I mean, the fact is that, and I saw an article over the weekend, and somebody, a very well-regarded, very famous investor, said inflation is how empires die. And it's
Wow.
true. If
Mm,
you look at the Roman Empire, um, the first thing they did was they started to debase their currency,
mm,
right? Too much war, too much spending, they debased their currency. And this is what happens again and again and again. This can be the end of countries, it can be the end of societies. It can certainly lead to changes in government. It's a violation of the social contract, so it can lead to social instability. Yeah, we can have a lot of bad things happening right now, or maybe at some point in the future. And if we take a look, and this is more COVID related than inflation related, but there are protests in the streets all over the world, in Australia, Germany, Canada. We're about to have civic unrest in the United States as well, right? These things tend not to happen when people are employed and making good money and happy and comfortable. Now, I realize I'm conflating two issues. and the current protests are more related to COVID restrictions than inflation. But trust me, it's all going to get lumped in with a very unhappy population.
So what can the central bank do? They can just higher the rates, or what will be the problem in that case?
Right.
Because they are supposed to do that in the coming months, right?
Right. They are, but let's talk about the difference between supposed to do it and actually doing it. And I think they will, but here's the problem, Eric. When you raise interest rates, one of the reasons why markets have traded at such high multiples is because we've had low interest rates for so long. And high interest rates cause people to move out of equities and into bonds. And when that happens, equity valuations drop. So earnings may be fine, but you'll get a lower multiple on that. So, there was something called the Greenspan put many years ago. Now it's called the Fed put. And basically at some level, the market will have fallen enough that that basically the Fed will say, okay, well, we don't want to crash the market, right? And it's this conflict between Wall Street and Main Street, where Main Street, the average citizen really needs the Fed to raise rates to get a handle on inflation. But what the Fed, but what Wall Street wants, what the markets want, is low interest rates and high valuations. And so if the market crashes, the Fed put would be, okay, wait, we'll take it easy on interest rates. Now, back in the late 70s, early 80s, Paul Volcker, who was the chairman of the Fed, said, I don't care if I crash the economy, I'm fixing this inflation problem. And he took rates up, I think, past 15%, right? And Chairman Jerome Powell can't do that right now, and he can't do it for two reasons. One is he's afraid he'll crash the market, and if he raised rates that high, he would. And remember, we're coming from negative, in my opinion, 15%, but officially negative 7.5%. But the other issue is the United States has on balance debt of $30 trillion. So what happens when you raise rates? You start to get to interest rates of 4 or 5%, and all of a sudden, all of spending that the U.S. government does is going to be taken up in interest payments. And that's a big problem when you don't have money for a military, for welfare, Medicare, Medicaid, Social Security, right? Any social safety net, any government programs. And, those promises have been made. So, we go back again to your question from before, which was, why does any of this matter? It matters because no matter how this gets solved, people are going to get hurt.
This sounds really serious. So what do you think will happen in the coming year to the stock market, to the interest rate?
Yeah, well, interest rates, they will go up. They have to. The problem is Chairman Powell cannot raise rates as much as he needs to. With $30 trillion of debt and a market that will crash, he just can't. So it's going to be a half-hearted effort. And, it's too bad. It's not entirely his fault, but he doesn't have a lot of good options. Regarding the market, here's what we've chosen to do. We're doing three things. One, we continue to own a limited number of companies that we've researched, written about, and expect will do well, because I think long-term, they're really good stock picks. And then we're hedging the portfolio in two different ways. We have a set of inflation hedges, which we spoke to you about when we checked in with you a couple of months ago. And then I mentioned earlier in this call that in the first week of January, we advised Deep Knowledge Investing subscribers to short the market. And we put out a piece, I think it was out on January 8th, telling people short the S&P 500, short the NASDAQ 100, the ticker's the QQQ. We bought huge amounts of put options on the S&P 500 that doubled and tripled, and then we sold those and bought cheaper options further out and booked huge amounts of profits on that. This is the kind of thing that we're managing very carefully. And I communicate with Deep Knowledge Investing subscribers on that whenever we're doing something like that in the portfolio. So the three pillars we have are own a limited number of great stocks, hedge for inflation, hedge for a market drop if we have an increase in rates.
So do you think the market will go even lower from here?
I think it's interesting because last week the market was up really big one day because the minutes from the Fed meeting indicated that instead of raising by 50 basis points or 0.5%, they were only going to raise by 25 basis points or 0.25%. And people are excited about that, and okay, fine, but at some point they've got to deal with the problem. So they can kick the can down the road, right? They can let inflation run hot and keep the market high. But at some point they're going to have to raise rates a bit, and I'm not so bullish on what happens in the stock market in a rising rate environment.
Oh, okay. So I also have to mention the situation, the serious situation in Ukraine. How do you see this connected to the rest of the economy? Is it anything that you are looking at?
Well, I think. So first of all, I just want to be clear, the only thing we're really comfortable commenting on is the economic impact. Obviously, there's a potential humanitarian impact if there's war or a country that's invaded. That itself is a horrible thing, but I don't know that our commentary on that is particularly valuable, and it's not why people come to us to take one side or another. But obviously the key issue is that Russia is a huge oil exporter, and they're a huge supplier of European oil. So anything that creates an imbalance of supply in the oil market, and remember, we told people, this is back in, I forget, it was October or November of last year, that when we were hedging for inflation, we were buying oil. Well, great. Well, last I checked, oil was above 90, and certainly anything creating instability in Russia or sanctions that would prevent Russia from exporting oil is going to have a negative impact on the oil market. And by negative impact, I mean higher oil prices. So we've continued to own our oil positions through all of this.
So you have had some really good calls, it sounds like, but what should people do? I mean, what should our investing community do? What should they invest in? Commodities, housing, banks? Do you have any ideas of what people should invest in this inflationary environment?
We do. So our inflation hedges are fortunately not so different than they were a few months ago. We continue to like oil. In that sector, we look at high quality producers that have existing operating wells. And the reason that matters is because environmental concerns make getting new wells permitted. So having an existing supply of oil right now is very valuable. Beyond that, we own gold and silver. If you bring up a chart of gold, that's done really well lately. That's a tough one as well because storage is difficult for people. You really have three options. One is to store gold at home, but then you have precious metals at home and you're running theft risk, and depending on whether you live in a high crime area or how much money you want to spend protecting it, that may not be so safe. I don't keep gold in my house for that reason. I just don't think it's the safest way to go. There are people who use dedicated gold storage or safety deposit boxes. I would say in case of emergency, it may be difficult to get your hands on that. A final option is the ETFs GLD for gold and SLV for silver. They do have some expenses, but they're easy ways to do it. Detractors there would say, yeah, but what if they don't own as much gold or silver as they say they do? And there certainly is risk to something like that. So there's no perfect way to play it, but we've continued to own that. Long term, we own Bitcoin as well. Bitcoin has traded as a risk asset, meaning whatever the market has done, Bitcoin has done more. If the market is up, Bitcoin is up more. If the market is down, Bitcoin is down more. So it's traded as a risk asset, but in a hugely dollar inflationary environment, I like the idea of owning a deflationary asset. That's Bitcoin. So those are the key things that we've thought about. Regarding housing, I have two thoughts on housing. One is, in a situation where you have inflation, owning hard assets is a pretty good idea. And owning hard assets that you can leverage is a great idea. So just on a personal note, back a few months ago, I refinanced the mortgage on my house. And it's an inexpensive interest rate. It's a 30-year fixed rate interest only for the first 10 years. So let's think it through for a minute. If we have inflation at somewhere between 7 and 15% for a while, I get to pay the bank back with dollars that won't be worth very much. And, my joke is 30 years from now, here's a pack of gum and a candy bar and use that to pay the mortgage. Now, obviously it won't be that good, but I'm making the point that, you get to pay back that mortgage with dollars that won't be worth as much. The one thing that I would caution people about is higher interest rates mean higher mortgage rates. So if you own a home and you're going to live there and you don't plan on selling it, refinance now, please. Just lock in whatever rate you can get now for as long as you can and do that. The thing that they need to be careful about is, if you're thinking about it as a short-term flip, a short-term trade, that can be a problem in a rising rate environment. So in the United States, I think we're going to see mortgage rates go from around 3% to around 5% over the next year. If that happens, for buyers to have a mortgage payment that's the same, prices need to adjust by 20%. Right? If it's 150 basis points, so 625 basis point increases, mortgage rates go from around 3, or in this case, like 3.5 to 5, you'd be looking at a 16% change in value. And that's a pretty big hit to take. So regarding real estate, the real question is, how long do you plan to hold it?
Okay. Gary, it has been, as always, very interesting. We only have like 30 minutes, so I think we have used all our time already. How can people learn more about it? You have a webpage and people can buy your service, or how does it work?
Yeah, they can. Thanks so much for asking. Anyone watching this who's interested, feel free to go to www.deepknowledgeinvesting.com, and you can sign up directly from the website. We also have a special offer for invested.dk subscribers. Wow. Eric, we have a special landing page for you. Eric can send that out.
I will send it right away. Yes, when you send it to me, I can. Yeah.
Sure. Great. And we'd be happy to offer all of you a free month, and would love to have you as part of our community as well. Thanks.
What can people expect from your service?
So, like I said before, it's really two key things. One is a limited number of high return, high probability stock picks. The other is we've been very focused on inflation and interest rates, and we've gotten that market call right. We had people positioned in gold back in November. We had people shorting the market the first week of January. We've been really timely on that, and that's been the key call for us. For what it's worth, when we started telling people to hedge for inflation, the expectation for 2022 was the U.S. Federal Reserve would have 0 rate hikes in 2022, right? That it would just be 0. And we said, no, that's not right. Inflation is worse than people think. and start hedging for this. And I saw something over the weekend. Some of the big investment banks are now expecting as many as 9 rate increases. So our work has been predictive and people have made money because of that.
That's impressive. Well, thank you a lot, Gary. Are you having a holiday down there, or are you just working?
Just working.
Okay.
I just, we can work from anywhere. And so I stay at places that have a really good Wi-Fi connection and co-working spaces. And I'm just living and working in Peru for the month. Last time was Costa Rica. And
Fantastic.
So I don't know, maybe later in the year, Denmark, who knows?
Yeah, but choose summertime instead of wintertime. Yeah, but you're very welcome.
Thank you.
Thank you. Nice to see you again, and hopefully we can ask you again another time to have an interview with the invested community.
It would be my great pleasure. Eric, thank you so much for having me, and to all the members of the invested.dk community, thanks for your time. Thanks for joining me at Deep Knowledge Investing, and we really appreciate you. Mange tak.
Thank you. Mange tak. Vi ses. Hej.